Let's just look at this together.
Yeah.
I would want you to read one more time and then we'll discuss. A US based investor is long euro 2 million. So basically it's a US based investor.
Yeah.
So I would believe that his currency will be the price currency, and anything that he would trade in, let's say euro in this case,
Yeah,
will be called as the base currency. Okay?
Yeah.
Or I can call it a foreign currency. So he's saying he's long euro 2 million. The portfolio manager decides to jointly hedge the risk of the asset return measured in euro and the risk of the currency return to minimize the volatility of the portfolio's return measured in USD. ठीक है? When I'm going to read this, I can feel कि इतना भी कुछ ठीक है, इतना कुछ खास information नहीं है मेरे लिए. ठीक है? Then it says the manager first adjusts all the currency codes to measure the value of the foreign currency by expressing the currency codes in USD by euro, which I totally understand. Again, this is not very relevant for me right now. So I would say, okay. Yeah. And then I said, he then calculates the weekly percentage changes in the value of the euro. So basically it's trying to calculate my returns. When I say percentage changes, whether it is negative or positive, but I'm looking at my returns. So I'm calculating my weekly returns. So I'm calculating returns of RFX and my unhedged percentage changes in the value of the portfolio position measured in the portfolio domestic currency RDC. So it says, and then I'm also calculating my unhedged percentages change. Basically, again, I'm doing some percentage change for my RDC. So calculating return of RFX and of RDC, right? Okay. And I said it performs a least squares regression analysis and determines something. Now, what I'm going to do is, and then it says the correlation between RFC and RFX is 0.75. So if I basically write the simple equation that we know, RFX plus RFC, so the correlation between these two, they said 0.75. And then it said that when he did the regression between these two,
RFX and RDC, okay.
Right? When he did the regression between these two, it turned out to be something, right? We'll look at the equation. But then said he did the regression between these two. And then he said that I got an equation which has been given by RDC equal to 0.12 plus 1.25. And I can see that there is some change of return, but then I'll say it's something, right? I don't mind for now. And then there is some kind of error. This is the equation that I have. Is that correct? Now the point that they're trying to make here is, and then this looks very complicated, but the idea is that this is kind of intercept term which is constant. Yeah. I don't know error. So can I say that my RDC is directly proportional to 1.25x? Is it right to say?
Yeah.
Yeah, slope ho gaya?
Yeah. Slope.
Now, the important point here is we very well know that my hedging ratio is the slope of the returns between two things, right? I'm just talking very generically so that you will know how to identify a similar question in the exam. My hedging ratio, if you are to hedge, you have a product A and you want to hedge it using B. It is important to understand how my A behaved versus how my B behaved.
Yes.
If my A and B exactly behaves, then longer A can be hedged by shorter B.
No, this is slope.
I have exposure to A, and if A and B, if I do the regression and I get to know that A and B exactly behaves similarly.
Yeah.
In that
you
case,
get
if I'm
correct.
And that's how I can 100% hedge.
Yeah.
Right? Now, the point is that how would I know that how A is performing and how B is performing? Because we did a regression, right? And the slope will then tell me how much should I hedge. Basically, how much they are related. Okay, this is the regression slope.
Okay.
So the point is that if it is 1.25, it means we will have to hedge. The hedge ratio here is 1.25. Basically, it is something like 4 by, let's say 5 by 4.
Yeah.
Right. So basically, if I get a return of 5 on A, I will get a return of 4 on B. So basically, one of my parameter is moving faster than my proxy that I'm using. Again, I discussed that with you before, that if you are doing let's say you're using forward contracts, right? And there's a one-to-one mapping. You did 2 million, you did 2 million. You're doing 100% hedging. It's a one-to-one ratio. Don't worry about hedge ratio at all. But in a situations we are using some kind of a cross hedge, you are using some kind of a proxy, or we call that as the indirect hedge, right? I gave an example of US equity market versus S&P 500 futures.
Yeah.
Although I said that they are highly correlated doesn't mean one. Does not mean.
Does not mean one. Yeah.
Right? Which means that if this moves by, let's say 5%, and if there's an 80% correlation, it means this will move by 4%. Is that true? In that case, I will have to hedge my S&P futures 500 1.2 times of my US equity to completely hedge my US equity.
Yes. Yeah.
Right? So this 1.25, this explains that if you have to hedge 1 million of USD, you will have to use 1.25 million of futures. Is the concept clear?
Concept's clear.
Okay. So this is what it exactly says. Then when it did the regression between these two, it realized that the hedging factor is 1.25, but then it didn't tell you the exact word that the hedge ratio is 1.25.
Yeah.
It gave you an equation, but since we know that hedge ratio is the regression slope, so we know that this is the hedge ratio.
Okay.
Right.
Yeah.
So the point is, they're saying that they're long 2 million.
Yes.
Right. So I can say that I will have to do 1.25 multiplied 2 million short.
Okay. Short. Yeah.
Because the original position is long euro.
Yes.
To hedge it, I will have to short euro.
Yes.
With what ratio? The hedge ratio. The value is 1.25. Right? And then so 1.25 multiplied 2 million. Is that okay?
Yeah, that's okay.
Okay. So we just saw that this information that we just saw it just looks very complicated.
Yeah.
But the idea was that the only thing that they could have replaced with this whole thing is by mentioning that 1.25 is a hedge ratio. Okay. So rather than mentioning that 1.25 is a hedge ratio, they gave you the whole definition that they did the regression between the two things. And this is the equation that they got, which means you really need to look at the slope here.
Got it.
Okay. So that was the only question. And then it says, comment on how effective the hedge is likely to be. Again, you can see that the correlation here is only 0.75. And also we know that correlation can change with time. We talked about it.
Can be?
The correlation can change with time.
Yes.
right? We talked about it before, which means that if we, first of all, what we see over here is that this is a kind of a cross hedge. Obviously, just because we have 1.25 here, so we know that this is not kind of a perfect hedge that we are looking for.
Yeah.
So it means the ratio is not 1:1. So first of all, it's a cross hedge, it's not a direct hedge.
Yeah.
Okay. And secondly, even the correlation is low. So as long as the correlation is higher, we can say that, okay, it could be a good substitute. But this 1.25 is based on the historical data.
Yeah.
But when the correlation is really too low, and if the correlation changes, obviously the performance is going to change, which means the hedge ratio is going to change. And again, the hedge will not be perfect.
Got it.
Right? All right. Let's just look at this, read this basically. This is a cross hedge that we understand. And based on past correlation, obviously we can understand. Right? This is all historical data. The correlation can change and the hedge may perform better or worse than expected. Right? In addition, the correlation of 0.75 is not perfect and there's a random variation even in the past. Okay, that's fine. Right? So the idea here is, first of all, this is a cross hedge. And second of all, the returns that they did the correlation is, and the return that they calculate the hedge ratio is based on the historical data. Right? It just says that based on the historical data, this is the value. So obviously, if the past is not a good predictor of the perfect or of the future, right? In that case, you can't say for sure that this is something that you can get ever in future.
Understood.
Is it okay or is it perfectly clear?
Perfectly clear.
All right. Let's just proceed. Now there's a last topic in this chapter. Fairly simple stuff. So they say that you want to manage the currency that we have been discussing so far, but in the emerging markets.
I see.
By the way, is my voice loud and clear?
Yeah, it is.
Okay. So one of the problems in emerging markets, you can look at India, although we are moving towards a developed nation. I mean, but we have been moving towards developed nation from last 15 years also. Right. So the problem, one of the problems in India and other emerging markets is the higher transaction cost. Right. And obviously another bigger problem is probability of extreme events. So think about this. I was watching this series, Rajiv Gandhi assassination, on Sony Live. They just released it, and obviously it's so unpredictable on what can happen over it, right? And my dad always used to say that if you are trading, ensure that you close the trade on Friday because you never know what's going to happen on the weekend.
Yeah.
Right. So we are studying this, but our parents who are involved in this kind of stuff, they have been experiencing this in their lives.
Yeah.
So that's another problem with emerging markets, that you don't know what could happen over the weekend, which could change everything on Monday. Right. Also, this is a very generic thing. Also, something that worth noting is that the low volume traded. I hope you know that the biggest currencies in the world that trade happens is USD,
Yes,
Euro, and GBP. Right? These are the most traded currency, and the whatever transactions happen worldwide, mostly in terms of export import, they are being done in these major currencies. Right? So when it comes to other currency pairs, the volume traded is little less. So obviously, you can imagine how DMart is selling and how our local shopkeeper is selling. When the volume is high, the profit margins are low, but the prices are low. Right? But a normal shopkeeper who's going to sell you at a higher price or maybe at an MRP without any discount, because he's not selling in volume. Right? Which means that when the
volume,
so when the volume traded is low, it means that the spread is higher.
Correct.
I take it a simple example that the shopkeeper is going to buy kurkure at 8 and will sell at 10, versus a DMart is going to buy at 8 and sell at 8.5. Because because he's just going to sell 2 versus going to sell 200.
Yeah.
Right? So spread in this case is 0.5, spread in this case is 2 rupees.
Yeah.
Right? So another problem is that the volume traded is low, so the spread would be higher. And again, you can imagine that when the volume traded is low, the liquidity will also be low. Right? One of the biggest problem with liquidity is, although we don't realize this, but I've experienced it myself. I didn't used to look at volume a lot, so but I trade a lot last year and then 3-4 years before. Basically, my daily trade was approximately 25-30 lakhs daily trade.
Wow. Wow.
Right? So I entered into, I mean, I bought 2,000 shares of a stock, and I didn't realize that it was a pretty small cap stock. And the volume rate was too low. And when I traded, I realized that I became a market maker kind of a thing.
Oh.
Because whatever I put, it became the market price then. Right? And I thought that the volatility is too high, so I bought it. And then in 2,000 stocks, I got those on parts. Where first 50, 500, then 700. So the order got filled very, very late. Right? I bought this. I kept it for a few days. And then when I saw that the market is not moving too much, I said, okay, let's just chuck it. I don't want to put my money. Anyways, I used to trade on margin. So the interest was too high. So I said, okay, let's just sell it. Selling 2,000 shares was a mess. I was looking at the order book and people were trading 5 shares, 10 shares, 100 shares. Disposing of my 200 shares was a bigger thing because I also know, and you would also know, that these are transparent markets. So when you put a trade, everybody can see your order book. So on a stock where the volume is too low, putting 2,000 shares sounds like that somebody has got the news and he's trying to sell off, dispose of his position.
I see.
Right? And then we all know that iceberg thing that you put that your 50 shares only, and probably, just make it or break it kind of a thing, which means that you put in and then it would either got executed or get failed. You know all of the games, right, about equity.
Yeah, yeah.
The point is, I had to sell in a lot of 50. And it took me a lot of time to sell it. So liquidity plays a major role in markets because getting exposure, it's one thing if it is down market, but selling it off is another big problem.
Yeah.
So when the volume is low, when there's not enough liquidity, and when the transaction costs are high, when the spreads are high, it is difficult to execute a trade, and hence you would see these issues in the emerging markets. Okay. Another thing is, if you're looking at USD Euro pair, again, this is pretty much in line with what we have discussed. So you will get this. But if you're looking for currency pair, which is not so liquid, so even it is hard to find that currency pair, and you might not even get a currency pair in your currency. Maybe the amount, the volume of amount that you want to trade in will be too high than what is available with the dealer. In that case, you might have to convert in some other currency, and then you find that pair. Does it make sense? Let's say you're looking for CHF versus INR by CHF. It is difficult to get this value, right? So you might have to go through INR by USD and then USD by CHF and then do a cross. Right? Okay. Another problem is that the returns are non-normal. Now, what does that mean? Obviously, the tail risk is too high. Is a normal distribution.
Yeah.
Right? And then you will have a non-normal distribution, either this or that. Right? So the probability on the positive side is low, right? And we know our psychology. Does 10% appreciation in the price make you happy? Okay, yes. But does 10% loss make you a similar
No.
upset? It's gonna make you much more upset, right? While I could be just 10% happy or 50% happy, but I will be 100% sad if I'm got a similar loss.
Yeah.
So even our psychology is not normal. We don't look at, we think about volatility as only loss.
Yeah.
The volatility is about the movement, right? It could move either
Yeah,
ways.
yeah.
That's something our problem is, and why do we feel so? Because we are in the emerging market, so our thought process is very similar. That any kind of a negative news, it just dishearten us so much. Right? Another problem is, and I'm giving you all the pointers so that you would remember, and when you read, you would also understand these things in points. Another one is contagion. Right? I usually call contagion as jungle ki aag.
General?
Jungle ki aag. So जंगल की आग कैसे लगती है? एक पेड़ में लगी तो पूरे जंगल में लग जाएगी, right? Right, the Arizona and Amazon. That's your contagion, right? What's your contagion is that no matter how much you diversify, no matter how much you try to be a street smart, when there's a situation like this, they all have a correlation of one. Matlab, the exact time when you want to pull your money out is the time when they will not start performing. They won't perform. Okay. And this has happened, right? So again, I've done a CFA and I always think that, okay, I have some knowledge that I would know. I would not just go blindly invest in the mutual funds. I'll just go check the stocks, check the sector location, etc.
Yeah.
Point is, when there was a crash after India, basically the BJP lost last year, not lost, but then the expectations were too high, and then it performed too low, and I could see the market was crashing. And I had investments in various different asset classes. None of them was performing good. None of them. Right? And people then started investing into gold, while I'm not a strong believer of investing into gold.
I see.
Right? So even that's another problem. And then similar to this non-normal distribution, we understand the tail risk. Right? This again the tail risk, the negative outliers that you look at. And one more thing that you would look at in emerging markets is, and this is another bigger problem, there's a lot of government intervention.
Yes.
That's another bigger problem in emerging markets. If you remember our CFA level 1 demand and supply thing, right? You would know that if the demand goes up, the price goes up. If the price goes up, people will not trade. People will not buy. When people will not buy, the supply goes up. When supply goes up, the price comes down. And that's how it comes in the equilibrium. We know the basic maths.
Yeah.
But when the onion rate was 100 rupees, Mr. Arvind Kejriwal was selling onions at 30 rupees from Safal in Safal stores. क्या होगा? कभी डिमांड कम नहीं होगी?
Yeah.
और इसलिए हमारी कंट्री में we don't have inflation. We don't have inflation. We have stagflation. इंडिया में इन्फ्लेशन नहीं है, इंडिया में stagflation. Right? So the problem is that government intervenes a lot, and I hope you know that central bank is being called as the independent group who can look at the interest rate holistically, and depending upon the price stability and their long-term view of inflation, they manipulate the change the interest rates. But I hope you also know why Raghuram Rajan left the RBI.
Why is that?
The sole reason was that even he was instructed कि तुम ये करो और ये मत करो. The government intervened too much and he said, look, मैं इतना पढ़ा लिखा हूँ, don't tell me. तुम साले गवार, मुझे बताओगे क्या करना है.
Yeah.
पर उनको ये था भाई हम हैं, देश हमारा है, हम बताएंगे तू जो कह रहे हैं वो कर. उसने बोला भाई मैं जा रहा हूँ यूएस. ठीक है ना? And then I think if he was the last RBI governor, you would remember. And then after that, so many people changed, nobody knows.
Yeah.
That was the only reason, because they are being supposed to work independently. But then in India, at least, I would not know about other emerging markets, government intervenes a lot. That also makes a lot of issues overall when it comes to trading globally, because they can do anything. And sometimes when I say government can intervene, another repercussion of that is that they can actually block the currency any day. They would say that INR will not be traded. You will not be trading in INR. And you would also know, although India doesn't come under that category, but China comes under that category of manipulating the currency. They devalue their own currency.
Yeah.
Right. So the discussion will go little. It will digress a little bit. So I am not digressing, but just telling you something, that government can also play a major role in usage of the currency, which means that let's say you have a bigger trade, and if the government thinks that exchanging of that currency could change my currency amount, basically it could depreciate or appreciate my currency, they could put some regulation overnight and can block it.
Yeah.
Right. So if that's the case, to avoid that, there is something called as NDF.
Okay.
NDF. It is called as non-deliverable forwards. The idea of NDFs are that no matter whatever you in whatever currency that you trade in now, it will always be first converted into a major currency. What does that mean? Let's say you have a currency in USD by INR, which means INR is the foreign currency in that case. You will have to convert all your transactions into USD and then trade upon it. Basically, you took a forward in CHF, right? You took a forward in CHF that I am going to buy a CHF 3 months later.
Okay.
Again, don't confuse that with hedging. I'm just looking at a normal forward contracts where you are trying to lock in the price. So I said I am going to buy 1 million CHF 3 months from now, right? A simple forward contract. But in case of NDF, I would convert my CHF to USD. Now, the thing about this is, since you're already converting your CHF to USD, right? And when you deliver as in towards the end of your duration, 3 months, the idea was that you will, if you are long CHF, so you will be short USD and vice versa, because that's how you exchange. If you are long 1 million CHF, so you will be giving away USD equivalent, right? But in case of a NDF, since you are converting both into USD only, right? So the net thing that you could do is you can do a netting. Hence, it says it's a non-deliverable forwards.
Yeah.
Right. Let me re-explain this again.
Yeah.
Just in case it is not very clear. So basically, think about this situation where this is t equal to 0 and this is t equal to 90. Okay. I said I'm on this day, I said I'll be long 1 million CHF. Right? Am I going to make any trade over here? No. I'll long, basically I'll buy 1 million CHF on this date. Is that correct? Now, what I'm saying is, ideally, under normal circumstances, I would have, on this t equal to 90, I would have bought 1 million CHF and I'll exchange it with appropriate USD. Is that correct?
Yeah.
How we should do?
You're supposed to, pardon?
Is that correct? That if I'm going to buy 1 million CHF, right? So I will have to give up a USD, right?
You have to give away, yeah.
So far, so good?
Yeah, so far so good. But yeah, so far so good. So this is between USD and Swiss only. Not
Yeah. I'm assuming CHF versus USD.
Okay.
The point is that under normal circumstances, we would have done this.
Yeah, correct. Correct.
But under NDFs, we here also assume that I will have to convert this into USD even at t equal to 0 on the spot rate. So what I'm trying to tell you is, let's say the spot rate here is 1.05 that you forwarded, and this is 1.07.
Yeah.
That's the reason that you are trying to go long, because you think that I can buy cheaper.
Correct.
So what you can do is, under normal circumstances, this does not matter. Under normal circumstances, your spot rate does not matter.
Yeah.
And all that matters is that what will be the rate as on t equal to 90 that you decide upon already.
Yes.
And you will use that to exchange.
Yeah.
But in NDFs, they assume that on the spot rate, although you want to buy CHF, how much USD is as on the spot, and then they calculate how much USD will be as of this day, right? And since both the currencies are in USD, you just do a netting.
Okay. Oh, so I get it, but it's used essentially when the other currency is not liquid enough.
Is not liquid enough, or there could be issues with the emerging markets. Yeah. But when it comes to solving a question in the exam, they will tell you that either they'll use two words. First, they'll clearly tell you that this is an NDF contract. First option. Second option, somehow in the paragraph it just tells you that this is a kind of emerging market, right? So he's thinking to trade in dollars. Somehow the language will tell you that this is not the forward contract that I'm looking for. This is the question of NDFs. Okay, let's just try one question and see if it makes sense.
Trader buys you. So for this question, don't you need to know what the spot rate is currently as well?
No, the transaction will happen then on T equal to 90, right? So when I'm looking at 1.07, that will be also given as forward, but then this will be on the spot. This will be on the spot on this day, and this will be known today, but this will be as of any transaction that you do will do only here, right? You cannot add or subtract from this and this. So although you will be calculating over here only, but then that effective will be at equal to 90.
Okay.
So it says A trader buys euro 1 million 6 months forward at RUB. Basically, this is Brazilian ruble, right? Something, whatever. Real. Okay. So it says 6 months forward at 39.
Yeah.
And 6 months later, the spot exchange rate is 40.
Yeah.
Calculate the cash flows that will occur at the settlement. Okay. Let's just wait as in let's just sit back and understand what's going on here.
So basically over here, what's happened is he bought a forward for 39 and the currency actually appreciated more to 40. So he'll actually make a profit over here.
He actually made a profit over here. I can see that. Yes, he buys euro and euro has appreciated. Yes, I agree with you. Yes. Now the question is how much?
Yeah. Is it said to put it in USD? Do I need to convert it to RUB? The 1000.
RUB में तो converted होगा ही नहीं कुछ भी.
हाँ, correct.
वो होने यूरो में है.
Correct. ठीक है.
Profit loss भी NDF है ना ये तो बड़ी currency में ही चलेगा.
हाँ. So it'll just be I'm not sure on this. 40 minus 39 into 1, but that doesn't make sense.
Okay. Before solving the question, we'll just understand कि हो क्या रहा होगा इसमें. Ideally, when it says the trader buys itne 6 months forward, so is it right to say that I'll say he will buy 1 million? I'm looking at T equal to 60. Okay.
Yeah.
I'm going to buy 1 million euro and sell 39 million RUB. Is that correct to say?
Yes.
क्योंकि if EUR by RUB by EUR is 39. So can I say 1 EUR equal to 39 RUB? ये base currency है, ये price currency है, ठीक है? So can I say that 1 million euro will have 39 million RUB?
Yeah.
Can I say that he will buy 1 million euro, but he will sell 1 million RUB?
He will what? Sorry?
He'll buy 1 million euro.
Yeah, and sell.
39 million RUB. This is as per contract.
Yeah.
Now think about this as per spot. As per spot, your rate is 40. 6 months later, the spot exchange rate is RUB by euro is 40.
Yeah.
So can I say that 1 million euro will be equal to 40 million RUB?
Yeah.
Is that correct?
Yeah, that's correct.
So is it right to say, and I'm not solving the question right, I'm just trying to make you understand that basically he sold 39 million RUB while he could have sold 40 million RUB. Can I say he made a profit of 1 million RUB?
Yeah.
Is that correct?
That's correct.
Are you with me on this or should I re-explain?
No, I'm with you on this.
Okay. So is it right to say that I have a profit in the whole transaction, I made a profit of 1 million RUB overall as per the spot. Okay. But now, as I said, that the NDFs are being traded in the major currencies. So can I just convert my 1 million RUB to euro?
Yeah.
How much euro will I get? What is the spot rate?
Spot is 40. So 1 divided by 40, which is 25 million euros. Sorry, 25,000 euros.
Yeah.
Yeah.
बस ये करना सिंपल है, सिर्फ प्रॉफिट लॉस निकालना है. Just ensure that you convert that to the major currency, and the rate you would use would be the spot rate on that day at the settlement date. Is that okay?
Yeah.
Obviously, we'll solve one more question because that would not be enough for me to get a confirmation that you have understood the concept.
Yeah.
But before that, let's just try these questions. We'll do one by one, okay? Let's see the first one and let me know whenever you're ready.
Peter Perkins has all three, right?
Sorry?
All three questions, right?
Yeah, but we'll do one by one.
Yeah, makes sense. So the first one, this is what you were explaining that day, which is the put spread. And so I put the answer as B.
Okay. And why C can't be the answer?
By 40. Because you're talking about downside protection over here, not that he's willing to curtail the upside.
Okay. So one thing is your answer is right. The right option is indeed B. But if you are sure why A and C can't be the answer, then let's proceed. If you're not sure, we can discuss, because you could be 50% confident that B could be the right answer, but I wanted to be 100% confident why A and C could not be the right answer.
Yeah, no, so the C one is because basically that is to curtail upside, not downside. And A is buy 50 delta call and puts on this thing. So that is like more like a, that is a straddle, basically. And then you're playing volatility over there.
Correct. So you are right, absolutely. So when it says willing to reduce the downside,
yeah,
to lower the initial cost, so it clearly means that they want us to sell the put.
Yeah.
Okay, because this will reduce my downside.
Yeah.
ठीक है, तो as I said, कोई भी ambiguous नहीं हो सकता कुछ भी. They will always give you some information, so they'll let you know क्योंकि cost तो इसमें भी कम हो रहा है. Even C will reduce the cost, but in C you will still be protecting your downside completely.
Yeah.
Right? But in B you will compromise on the downside, which is just said that they are willing to reduce the downside protection. Hence B is the right answer. Clear?
Yeah. Clear. Yeah. So for this one, the answer is B. Yeah, I can't hear you.
Can you hear me now?
Yeah. You know.
Okay. Why can't C, or maybe why can't A? I'm okay. C cannot be the answer. Why can't A be the right answer?
Because in order to do minimum variance hedge, you need to sort of make sure that like whatever you're hedging, it should be equal, like in terms of the slope coefficient into the notional. Yeah, I'm not very clear on the answering.
So my let's just look at this. Jane manages a CHF hedge fund. GP is currently invested into diversified portfolio in UOG stocks. It regresses the monthly the regression coefficient. Determine the quantity of GBP Archer will short to implement a hedge of direct currency risk and minimum variance hedge. Okay. So when the coefficient is 1.25, The question is now, should we go for GBP this? Should I go direct? Acha, let's look at this. How about direct versus minimum variance hedge? In the direct hedge, should you be using the coefficient here at all?
No.
The way I look at it is, this 1.25 and the regression concept comes in where you don't have a direct hedging and you are doing some kind of a proxy, some kind of a indirect hedging, etc. Anything. So can I straight away strike out C?
Yes.
Okay, that's what my way of thinking would be, because in case of a direct hedge, I am not going to use the slope coefficient at all. C cannot be the right answer. Okay. Let's just talk about A and B now. So I'm okay because A and B both have $1 million, which I'm okay with. And I would know that in case of a MVHR, which is minimum variance hedge ratio, I'll have to multiply it with 1.25.
Yeah.
So A is out.
A is out, yeah.
Okay. So when you do the exam, when you do the real exam, if you're sure that this could be the right answer, go ahead. But while you are doing the tests, while you are solving some questions, my only recommendation is that ensure or maybe make sure that even though you are sure about any of the options, make sure that you read about or you should know why other two options cannot be right. If you think कि मुझे लग रहा है कि यही सही होगा आंसर एंड जो ऑप्शन सी है वो मुझे समझ नहीं आया, but I'm sure about B is the right answer, तो the answer is right, the B is right, but तुम्हें जो समझ नहीं आया जो C, you also need to go and read about it कि why is C is not the right answer.
Got it.
ठीक है. So this make this a practice till you have your exam.
Yeah.
All right. Let's try C. Let's try third.
A trader enters the short. I'm just confused a bit. So mathematically, the way I did it was, I said.
Did you arrive at one of the options first?
What?
Did you arrive at one of the options at least?
No, it's either. I mean, it's like that's what I'm saying. Mathematically, I got it, but I don't know if it's a loss or a gain.
But which number did you get?
I got a number that's closer to 4650 gain. But it could also be A 4600 loss. I'll tell you why I'm thinking like that. Basically, so he has to sell 2 million in the forward. Right?
He has to sell 2 million in the forward. Okay.
Of CNY.
One second. Can you see this line phrase? Right?
He doesn't.
I mean, it's not going to change anything. I'm just telling you, this is how you should see in the exam. Okay.
Okay.
So which would tell you that it's not a standard forward, but rather you will have to do some kind of a netting and calculate the profit or the loss, and that has to be in terms of the major currency.
Okay, so that 2 million at the forward is worth $327,040.
Okay.
But at the spot, that same thing is worth $322,400. Now, the only thing I don't understand is like, if theoretically he was shorting the CNY, means he was long the, like he had a favorable view on dollar. And the dollar is actually appreciated more than, because 1 divided by 0.612 is around 6.2. So the dollar is actually appreciated more than what his forward was at. So therefore, I thought it was a gain. But yeah.
I actually agree with you. This is kind of a trick question. Okay, because for any of the batch that I've taught, nobody could get this right in one go. So I am okay. You're a little confused, but let's just do this together. So it says enter 3-month contract, NDF, CNY. Oh, okay. So basically somebody has to sell 2 million CHF. Sorry, CNY. At CNY USD. So can I say that as per the forward, the rate is CNY by USD. So it is right because I want everything to be in major currency. So this portion is right. Okay. I want everything in CNY by USD and it is being given by 6.1155. Okay. And as per the spot, my CNY by USD is 1 by 0.1612. Right? How much is going to be?
This is 6.2.
So this is 6.2. Let me just do this on the thing because
It's 6.20347.
347. Actually, if this is at the 4 decimal places, I would also want to make it as a 4 decimal place for this one. Okay.
Yes.
Okay. Maybe 3.45. All right. So the trader's gain or loss is. Okay. So you did that part right where you said that initially on as per this, how much this was going to be? The total, how many? What do we say? Can I say that 6.1155 CNY is basically 1 USD?
Yeah. Yeah.
Right. So can I say that my 2 million CNY is how much you got some number, right? 327?
Yeah, 327040.
Itne USD.
Yes.
Is that correct?
Yes.
Now, what are we doing here? What are we doing here? So at the end of the period, what will be my gain or loss? So can I say that my spot rate is going to be 6.20347?
Yeah.
Right, minus 6.1155.
Yeah. Yeah.
Right, and then I'm going to multiply it with
2 million.
why 2 million was what? This is the rate in USD, right? This is the rate in CNY by USD. So how can you multiply by 2? That's 2 million in, is it 2 million USD?
No.
It is 2 million CNY.
Hmm.
So we'll have to multiply it with 327040. How much that value would be?
No, I'm getting some absurd number. 28,770. 1 sec. Yeah, I'm getting like some 28,780.
Okay, 28,780. Right, this is it. Now tell me, this is the important part here. Is this CNY or is this USD? This is where people get confused.
This is in CNY.
Sure.
Yeah, it's almost like 3270 is the USD amount. You're multiplying it by the CNY to USD. So the USD cancel out.
Perfect. If you got this right, you got the answer. So can you see that this 6.307, this is what? This is CNY by USD. This is CNY by USD.
Yeah.
Here, this is
Yeah.
6.20347 is CNY by USD.
Yeah.
This is also CNY by USD. Right?
Right.
And then you're multiplying, this is in USD. Not sure?
We are sure.
Hmm?
Yes.
Not sure, do let me know. Doesn't look like that you're sure.
No, I'm pretty sure.
Sure, okay. So can you see that actually USD cancels out? So what you get is the CNY. What you get is a CNY. And if you get this in CNY, the only job that is left out is to convert your CNY to USD at the spot rate which is available. What is the spot rate available? Is 0.1612
Yes.
multiplied with that. So basically, you said 28780 multiply 0.1612. That is the USD, and it's a gain.
Mm-hmm.
Shall we do this one more time?
Which this question?
Yeah. Or are you sure?
No, I'm 100% sure.
You will do this right in case you get a question on NDFs.
Yep.
Sure about that? Okay. ठीक है. I mean, just by the way you talk to me, by now I understand whether you understood this or not. So why do I feel that you're not very confident on this part?
I don't know. You'll be able to tell.
But you are. But you are.
Yeah, yeah. I mean, I got the right answer. I told you the. I mean, I was this between the. It was just for me the gain or the loss part, which was a bit confusing. But I did it a different way, and then figured that since the USD had appreciated, that it would be a gain.
Yeah, at least you that part got right. कि वो होगा तो gain वाली option.
Yeah.
Yeah, that's also a good way to look at it. ठीक है, fair enough. All right. Why does it? Why everything got selected? Okay. I wanted to solve just because we have finished this topic altogether. I would just want to spend some time solving a question, maybe another 10-15 minutes at max. Did they remove? Okay, this is a new book actually, so I don't know if they have a book already. Why they don't have questions in the end? So it looks like they have removed all the questions. But for consistency, just give me 2 minutes. I'm just taking a photo of the question so that we can solve, or maybe just. That's an interesting question to solve. One, hold on for a second. So derivatives, and usually what they do is after the whole reading, they give you a big question to solve.
Yeah.
And it should be there because that will be from all over the place. So that will be a good, what we have been studying so far is we study a topic and then we solve a question. But now looking at this holistically overall, that will give you some perspective.
Why don't I do this on my own?
Yeah.
But
then it's not. But then it's not available, so you would not be able to see. But what we can do is, maybe in tomorrow's or maybe in some other class we can solve that. Okay?
Yes, please. Yeah.
And let's just start the new topic. Shall we start with that, the performance evaluation, right?
Yes.
Still, you will have to give me 2 minutes because I need to see which that book is. All right, can you see?
Yeah.
So one thing is, Gaurav, I believe what we have studied so far was the more difficult portion than what we're going to study in rest of our sessions. Okay. Whatever we're going to study now would be fairly simple topic, simple calculation. Okay. But I'll keep on giving you an overview of whatever it is, and we'll keep solving the questions as usual.
Yeah.
One of the first that I'm going to start with portfolio performance evaluation is the concept on what are we trying to achieve in this. When I say that we are doing a performance evaluation, so the name explains that we are trying to evaluate what the performance of whom
of the portfolio manager
is the portfolio manager. Yes, that is true. But the catch here is that are we really trying to see the or evaluate the performance of the portfolio manager or the sponsor? Now the question comes in, how is portfolio manager different from a sponsor?
Sponsors like the LP,
the limited partners,
the client.
Okay. I agree, could be the client, not always. Right? Think about a foundation, think about a hedge fund company, maybe,
fund.
Right? Think about an endowment, think about a pension fund, right? So in a way, it's like one person has a vision.
Got it.
And then it just hires people to work under him. So they are the portfolio managers.
Yeah.
And he could be the sponsor. While obviously when he has a vision, he will have a view on where to invest, but where exactly to invest in detail would be driven by the portfolio managers. Right? So what you said is also right in a way, because if client is the sponsor and he would say that, okay, I want you to invest into small cap companies. So client gave a view that let's invest into small cap companies, but then which companies to select, how much overweight or underweight should be given would be driven by the portfolio manager. Right? So look at it from a client perspective or from a pension fund perspective. The sponsor is a bigger person under which you will have individual portfolio managers.
Yeah, correct.
Right. So my idea is that I'm trying to evaluate my performance, that my sponsor has given me better return or my individual portfolio managers have given me better return, and if better return or worse return, but then how much is what my idea of my portfolio performance management is. Right. Now let's talk about what are the different components of it. One of the component is performance measurement. Right? Basically, you are trying to measure the returns in a simple language. Important catch over here is very important that you, before you do that, before you calculate or you measure the return, it is important that the benchmark is defined. Right? And I am going to talk about a lot in terms of what a good or a bad benchmark is. But the idea is that you are trying to calculate returns with respect to something, right?
Yeah.
And the important thing I'm trying to say is that something needs to be declared in advance.
Okay.
This is very important.
Yeah.
Very important. Why do I say this? Because think about this. I get into something and I invested some money somewhere and my return is, let's say, 5%. So what I can then say is my benchmark was something that gave you only 1%. So I said, okay, I outperformed by 4%. It's easy to say that, right? So what my point is that when you get into a race, let's just define the benchmark first. That okay, I am going to trade or I am going to evaluate my performance based on S&P 500, and then you calculate that okay, with respect to S&P 500, did I give you more return or less return, which will be calculated. But then this performance measurement talks about the total return. How much overall? Total return as in the extra return, obviously. The alpha that I'm going to get with respect to the benchmark. Now, what I got to know is that I received X amount, which has been given by performance measurement. I measured it, then I received X amount. My second component is my performance attribution, which tells me from where. When I say where, it means what different factors, what different weights, what underweight, what overweight, or what not. Basically, what strategy did I apply to get X?
So the first one is performance measurement, second one is performance attribution. Sorry.
Yeah. ठीक है. तो this will tell me कि मुझे X मिला, मतलब मुझे 10% मिला. Performance attribution tell me 10% कहाँ से आया. ठीक है. I am going to dissect horizontally and vertically to understand how did I arrive at 10%. Right? And the third one is your performance appraisal.
Okay.
Right? My performance appraisal just tells me that I got this X return. I also want to know, is it because of my investment decisions, or is it because of the overall market, or is it because of luck? Right? And the reason why I'm telling you this is, think about this. I don't know whether you followed markets or not, but before election, right? You put your money in any security and you will earn.
Yeah.
Right? Matlab, my dad always used to say ki nobody can earn from mutual markets. If the markets are going up, it is going up. Markets are going down, it's going down. So I explained him the whole process one day, and I said, okay, I'm going to take your 20 lakhs and I'm going to show you how it works. I was lucky enough that markets were really doing great. Yeah. So I asked him, on 20 lakhs, how much are you going to earn by putting that in the account? And he said, okay, 4% से लगा ले, कितना मिलेगा? 8,000 मिलेगा, 80,000 मिलेगा. He was saying, 8,000, 80,000. Okay, I'll show you. And then I put that 20 lakhs into mutual funds. And within 1 month, I earned 1 lakh.
Wow.
And I said, not exactly 1 month, but 1.5 months. From day I invested, from the day I redeemed it. And even giving away 1% as an exit load, I gave him 1,10,000. Oh, sorry, I think around 95,000.
Wow.
Somewhere. And I said, really, you can make that much money? From that day onward, he's telling everybody, "Arey, wo sab chodo, stock market, mutual fund mein laga lo." While he doesn't know that I was lucky enough that market was doing really great that time, right?
Yes.
The point I'm trying to make with that is that sometimes the overall market itself is so great that no matter where you invest, it will give you returns.
Yeah, basically beta.
Yes. And sometimes you just got lucky.
Yeah.
Right? And sometimes I tell these stories and then I refrain myself from telling these stories because I said, you know what? I invested 20 lakhs this morning in a margin.
Yeah.
And by the end of the day, I got 15,000. And they said,
Yeah.
in 1 year, you earn 15,000. That's too much money, right? But then I just got lucky because there was a result coming up.
Yeah.
And I knew that, the stock is performing good, the fundamentals are strong, and probably, we got to know that there's a project that came in. He got a new project, and I immediately invested into it, and then we got. So, by the way, if I know that there's a result coming up, and if I'm confident that the company is going to perform well, that is again not really. That will again go to my investment decision only, right? But I'm saying sometimes you still get lucky that you don't have a view and you invest in something that goes up. The problem with that is that you might get a lot of return this year for some reason, but then
but
if you just got lucky, it will not be carry forward next year.
Or even
Right?
worse, it will reduce all the way.
Absolutely, and even go worse. Absolutely. So the idea is I am only going to vouch on the returns that came from my investment decisions and my ability, because if I know, and this will help me to understand from the attribution, because if I know that I overweighted this sector, and because I had a view that this sector is going to outperform and it actually outperformed, then I know how to make money even the next year.
Right.
So they say that overall there are 3 components to it. In a simple Hindi language, वो इसका मतलब होता है कितना मिला,
कैसे मिला,
कैसे मिला, और ये किसकी मेहनत से मिला. ठीक है. So now you can see I did the whole dissection of my performance.
Yeah.
Okay, so this is very important. Now it also says that my effective attribution, if I'm doing it really right, then my attribution should include the 100% of portfolio return, right? Or the risk exposure, obviously.
Sorry, what? 100%?
100% of portfolio return. So basically, if I'm getting 8% return, then I should be able to know that, okay, 2% from this because of this reason. 5% because of this reason, 1% because of this reason. So 100% of my return should tag to something so that it sums up to the overall return that I got.
Got it.
Obviously, if I'm not able to explain some part of it, I'll say that that's the error term. Right? If I'll only be able to explain 7% of it, but I got 8%, so obviously 1% will go to error. That's the reason you must know that in CFA level 1, we were trying to minimize the error. The whole concept of regression was that we were trying to minimize the error.
Yeah.
Right. So that's the reason, because I don't know if that's going to continue or not. So it's important that I will attribute everything to what I know and I'm sure. Second, it says that it will also help me. First of all, it will help me explain from where are the different sources of return.
Yeah.
It will also help me understand my manager's decision-making process.
Yes.
Right. It will also tells me how my active investment is working. Active management, actually not management, investment decisions. Right. And then it provides a full explanation on what's going on. If I can do this whole attribution thing, I would know everything about from where I'm getting, what's going on, what are different factors, and what the manager has done, what he could have done, where he's right, where he's not right. I can get to it. Now, it also says there is something called as return attribution. And obviously linked to that is my risk attribution. Right? And then it also says that when it comes to risk attribution, it is important that I choose the right benchmark, right? So that I can say that, okay, I am taking more risk or less risk than the benchmark, and my benchmark should be in line or has the same view of the manager. What I'm trying to say here is that let's say that my manager has is bullish or is bearish, or he has an expertise in large cap securities. In that case, if he is going to choose S&P 400, this is not the right benchmark for him.
Yeah.
S&P 500 would be the right benchmark for this manager. Does it make sense?
Makes sense.
Okay. एक और बात है कि this will also help me understand that whatever, since I'm going to get the attribution or maybe the results are too good.
Yeah.
But when I'm going to segregate everything with respect to different factors, right, then I would know whether the manager has, whatever the view he has invested in the same kind of securities or not.
Yeah.
Right? All right. Another thing that they talked about is micro attribution and macro attribution. Right? You can imagine the difference in the words of macro versus micro. So when I look at micro attribution, this is at a investment manager level, or you can say it's portfolio manager level. Right? While your macro attribution is at a sponsor level. Right? So what my point is that if I'm looking at my portfolio manager, it is only going to tell me what are the different drivers of the returns, what are the different factors, underweight, overweight, and whatnot. But when it comes to at a sponsor level, right, it takes about overall strategic investing, basically a long-term investing, right? And it also talks about timing of those investments and how much deviation is allowed.
This is on macro attribution. Okay.
At a macro level, yes, at a sponsor level.
This is not to be confused with macro movement. Yeah, got it.
No, it has nothing to do with that.
Yeah.
Okay. So macro has to do more with sponsor at a bigger level. Micro has to do with at a portfolio manager's level. Portfolio manager is only going to be concerned about what he or she is doing, basically related to his portfolio only. But obviously, how much risk can he take? How much risk a portfolio manager can take would also be driven by the sponsor.
Yeah.
Obviously, भाई ऐसा तो नहीं है ना कि कोई भी पोर्टफोलियो मैनेजर उठा के 100% रिस्क ले लेगा.
Yeah.
ऐसा तो नहीं है. So he will also think about this, right? That we create an IPS. So IPS says that you can deviate 10%, and then you follow the IPS, right? So the investment manager is उस 10% में कहाँ पे कैसे deviate करना है वो investment manager का call है. Is that correct? But जो हम बोल रहे हैं 10% deviate करना, right? When we say that you can deviate 10% or 15%, or you can do this or you do not do this, then that has been driven by the sponsor level. So we also want to evaluate that whatever sponsor has taken the decision, is that right or not right? Is that okay?
Yeah.
And then we also want to, the macro level will also tell me that whatever that I thought initially overall that, okay, I would deviate 10% or 15%, is it really up to the mark or has it changed? Basically, again, the attribution, but at a macro level.
Yeah.
All right. Now let's just dive into the attribution thing in detail. So basically there are, when it comes to return attribution, there are three types of attributions. One is return based, not return attribution, basically performance attribution, you can call it. एक ही बात है वैसे. One is returns based, second is holding based, and third is transaction based. Okay. In all the three, we are trying to calculate the attribution, but there are just different three ways to calculate the performance attribution. Okay. When it comes to returns based.
What's the second one again?
Holdings based. Holdings.
So
basically, what all securities do you hold in the portfolio? We do the attribution based on that. Okay. Now, in a return based, this is basically based on the regression. Right? So basically, it does the regression of the returns over the period of time. Right? We don't really look at the holdings in this. We don't look at holdings. Can you see the name itself explains that it's a return based attribution, which means only I'm concerned about the various returns and you regress them against what they have, how they have performed previously in last year or maybe 6 months before. Right? So basically, I'm not going to look at the holdings, right? But we do the regression against some kind of a broad market return. So basically, what I'm going to do for regression, we need two data sets.
Yeah.
So I'm going to do the regression between how my portfolio has performed versus how a broad market portfolio has performed.
Got it.
Right? All right. And I'm just reading if there's anything else that I have missed. Yeah. Lastly, that this is the easiest one. Because you don't need any kind of holdings, you don't need too much of detail. As long as you are being given some returns, you can easily regress and get to the return based attribution on how did it get it. But obviously, you can imagine that the issues could be, the style drift. Most importantly, the period, on which period are you looking at, right? And this could be manipulated. Think about, do you even know that a lot of funds inception date is 2008?
I didn't know that.
Okay. A lot of funds, especially the mutual funds that you would see, they have an inception date of 2008. The reason is very simple. You would also see a lot of funds have an inception date of 2020.
At the bottom.
Exactly. So when you start at the bottom rock, obviously the only thing that you will get is the upside.
Yeah.
And then that's when you start saying that, oh, my 1 year return is 56%.
I see.
Right? And a lot of people infuse money into those funds. Okay, that's another important thing that you consider when you invest in mutual funds, that how much history does it have. If there's a fund that has been giving you consistently 15, I'm just saying 15%. There are funds who give you 37, 40% as well.
Yeah, 15%. Yeah.
Yeah, exactly. But I'm saying if there's a fund that has been in the system from last, let's say 25 years, which means that fund has seen at least 2-3 business cycle and still can give 15% return consistently year over year, that's a good fund, I believe.
Yeah, absolutely.
Right. Then a fund, it gives 36% return, 45% return in 1 year, and then goes negative another 5 years. Okay. So obviously it is easy to manipulate because you can look at a period in which you think that your portfolio has done better because the markets were good. Let's say you have a beta. Let's say you have a beta of 2x.
Yeah.
Right? And it's a good market. So even you know that your returns would be better than the market.
Yeah.
And then you take that period, obviously, you will get more returns. So in the regression, you will get returns higher than the benchmark, and that's how you will be called as outperforming. But then that's easy to manipulate. Right? Obviously, another problem is that style drift. Think about this. When I say style drift, maybe your style is small cap. Your style as in the manager style. The portfolio manager style is the small cap. When he was hired, he said that I have basically my expert is into small caps. But he actually talked to someone and said small cap is going to underperform, so invest into large cap. And he blindly invested into large cap. Luckily, your large cap outperformed and the return was too high. But you are only looking at the returns. How would you know whether he has invested into small cap or large cap? Because the return based attribution only look at the returns and not at the holdings. Right? So another problem is, although the advantage here is, that it's easy to calculate. Only thing that you need is the returns.
Yeah.
And the broad market returns, obviously, as a benchmark, as a reference. But the problems are that it does not look at the style drift that manager could have taken.
Yeah.
It could give you different results for different periods, and it is easy to manipulate. Is that okay?
Yeah.
Okay. Another one is, I'll take another 5 minutes, okay?
Yeah.
Another one is holdings based. The name explains, since it is a holdings based attribution, it means you are now looking at the holdings. Right? So basically it looks at the holdings at the beginning of period. Right? And then it looks at the return that it gets overall throughout the period. But then it says the accuracy really improves, right, when you look at from an annual level, then to monthly level, then to when you for a small period, when you start looking at the returns on a smaller duration, your accuracy improves. Right? What I'm saying is, the problem with this is, in a holdings based attribution, is that you look at the holdings at the beginning of the period.
Yeah.
While the transaction could also happen in between.
Yeah.
That's the reason I'm saying when you move from annual to monthly and the weekly, the results improve. But even in weekly, think about this, you are looking at the Monday and then looking at the Friday. How about the investments being made on Tuesday, Wednesday, Thursday?
Yeah.
Right? So I'm saying, so the point is that there are investments somewhere in between, and there will be an impact of those investments in between, but holdings based does not take care of those. Right? Obviously, when you are looking at a more granular level, then the return based attribution, return based is only looking at the returns, while holdings is also looking at the holdings. So I can say holding based is better than returns based, but still not the best thing to do, because it is only take care of the beginning of the period data and would not really incorporate what happens after the beginning of the period, and you cannot imagine that the transactions or the buying and selling would not happen somewhere in between. You can't imagine, right? So I'm saying that it gives you a higher level of accuracy with respect to the returns base, but still not the best thing. And this is the biggest problem. So where this holding based can be used, this can be used for passive funds, or maybe index funds, you can call it. Think about this.
Sorry, but in the first one, returns based,
Yeah.
like, what's it? Aren't you also like regressing it over a time period? Like, what are you doing over there?
Yeah, obviously. So let's say you look at 6 months period. So you look at the broad index, and then you look at your portfolio, and then for last 6 months, how my portfolio has performed with respect to the market.
Got it.
Okay, you're doing the same thing over here, but there was no attempt, there was no the ask was to look at the holdings, while in terms of holdings you look at the beginning of the period holdings and then you do the calculation. But since you don't look at in between transactions, so holdings based is obviously better than returns based, and since you are looking at the holdings, it is easy to identify the style drift. भाई वहां पे तो दिख ही नहीं रहा हमें होल्डिंग्स क्या है, यहाँ पे हमें होल्डिंग्स दिख रही हैं, तो we can easily identify the style drift, what manager has said versus what he has done. It is easy. But the problem is, so basically these are the advantages of it, but again the disadvantage is that it does not look at the in between transactions, right? So I'm saying if you have to use the holdings based attribution, I think the best way to use is on the passive funds.
Okay.
Because even in passive funds, there's not much trading that happens in between.
Yeah.
So it would match the real thing, and you can get a good return. You can get the good result, right?
Super.
And the last one, and I would talk about this again tomorrow, but just to for continuity, let me tell you, last one is the transaction based.
Yeah.
Right. Now the name also explains it's a transaction based. It means it looks at the actual transactions. So whether it is now or later or somewhere in between, it looks at all of them. So it is obviously the best way. Okay.
Yep.
So in terms of least to best, easiest to hardest, but then least accurate to the most accurate.
Yeah.
Okay. So we'll quickly revise this again tomorrow. Just to give you some highlights, and then we'll start from there.
Yeah, sounds good.
Okay. Tomorrow will be class, okay? And tomorrow day off.
Yeah.
All right. Cool. Then I'll see you tomorrow.
Okay.
Take care. Bye.